Hey, this is Sasha, the options coach. In today's video, I'm going to share with you some insight on rolling threatened SPX credit spreads. Now, this can actually apply to any form of rolling or any other types of credit spreads. Based on kind of the question here that I've had, if we take a look at this question, hello all, can anyone point me in the right direction with a video, white paper, or resource on how to roll threatened SPX call or put credit spreads, or how to roll when it's trades between your strike prices? I'm confused on how to adjust these trades. Okay, so as we check some of these things out, this comes from Facebook groups here that I grabbed some comments on. You can check out our Facebook group as well. But anyways, as we take a look at this, I just put on a SPX credit spread. This is a 0-day credit spread just to kind of get some action and get something into some trouble. So just to give you an idea, I put on two of them, and one is kind of winning over here, and this is the call side, and one is losing over here on the put side. So anyway, there's a couple of different things to think about when you're rolling. Okay, so the whole point behind a roll is to give yourself more time or range in the position, or kind of save the positions in a way. And there's different ways to do that. So if we look at this position right here on the put side, and we're whipping around right now because of the Fed announcement, so that's why I thought this would be kind of a good opportunity or time to do this. So if we're starting to get into some trouble here on this side, especially if you're starting to go over here, one of the first things is looking at your risk to reward. Like this position's risking about 455 to try and make 45. So if we break things down on the position, and we have a risk to reward. Okay, so we've got a risk to reward of 455 to 45. Okay, so you're really, the most you can make is about 45 bucks. And when you can only make about $45, one of the things that you may want to do is say, okay, when I lose $45, okay, I want to go into a safer position, because what's happening is, let's say you've got this vertical here. The most you can make is $45. As it comes back into here, when you're down 45, what you can do is, if this is a 10-day, what you could do is take that 10-day and go into maybe a 20-day, and, you know, now put on a new position that's, let's just say you're trying to make like 60 bucks or something now, which in that case, okay, you're starting a new fresh position, and it would actually kind of extend this over here. So let me draw this part. So now you've got a new position that you're rolling, and you're kind of rolling it further out or to the left. So if the market here is, let's say, at 5,000, now you're going to, let's say, 4,800, and you're giving yourself an extra 200 points room, but you had to go into the 20-day or further out in time to try and make 60 bucks. Now, if you made 60 bucks, well, you lost 45 on the first one. So that gives you kind of still a positive $15 of a win between the two of them. So if we're looking at that scenario and situation, that's kind of what you're looking at doing right here in this case. So right now, this one is, well, it's holding steady. You're not really losing anything, but let's just say we're losing $5. Well, what you would do is you could close it. You could keep it in the same expiration, but with 0-day, there's not a lot of room to wiggle. And I could just move it. Let's say this side was getting into some trouble. I could move it now, close this down, take my 10 or 20 or $40 loss, and now move it to this one and the next one, kind of delta wise. And then you have kind of a new position that's a little bit safer. Or the other approach is, rather than going here, especially if this is getting a little close or tight, you could go to, let's say, a 7-day, give yourself a little more range or room. And then now what you'll do is, you know, sell something over here in this area to try and make up that difference. So if I lost like 45 bucks, I could sell a new one here to try and make up about $40 on this one, or get it a little bit closer. And let's go to this one, and we will go to 40.85 and try and make up maybe like $70. So lost 45, making up 75. And that's kind of the point behind the roll. Now with SPX, there's kind of no assignment. It's cash settled, so you don't have to worry about that. So even if the price starts getting into this area where now you're down like $100, what you can do is, you know, roll it, closing this position down, take your $170 loss and try and make that up. It may take you 2 or 3 times to make that up. But essentially, when you come down to a roll, is you've got kind of this initial position. Okay, so you've got kind of this, let's say, initial position of this credit spread. Okay, so here's our credit spread that we have. And then what we're doing is we're kind of extending it. But to extend it, what we have to do is usually go into a further date or time. So if this was like, let's say 30 days out, and then it ticked down to 20, now this one might go back up to a 30-day. Then again, you've got another one that's, if this one gets in trouble, then you keep rolling it again, and you could do this like a third time. And now this one, you might start at 30 or even a 20-day. So you might actually be in the trade like 60 days or something. But if the stock market was, let's say SPX was here, so at 5,000, then in this case, then it's, let's say 4,700. And then over here, let's say it's 4,300. So it gave you kind of a safer net. Here you lost, let's say $45 lost here. Then another, let's say $70 lost here because you were trying to make up some of the losses. And then finally, maybe you won one and maybe you won $120. Now, it might have covered just barely breaking even between them, but that's how you would kind of do the rolling process or procedure. Now, the other way, obviously, that you could go with is rather than just rolling it, you could cut delta. So if this is going down, you can sell the other side of it, which is kind of, in this case, the call side or the credit spread on the other side, to kind of hedge off of that and pay that off. But that's a little bit of a different thing. Okay, so looking back at this question, you can see there's confused on these credit spreads on how to roll and when it's between your strike prices. So even if it's between your strike prices, it doesn't really matter to some degree. It's just how much money did you lose at the time or value. I'm confused how to adjust these trades. I would say at a basic starting point for somebody new, let's say you're doing like a put credit spread. If you're trying to make $45 and that's the most you can make, when you're down about like 1.5 times that, so around like $60, kind of is the time to roll. If you're waiting a little too long, like it's 3 or 4 times the amount, now to make that up takes a little bit more effort or rounds or more rolling, because it takes longer. So when we look at all these expirations here and we see, that, okay, well, I've lost $50 here. Now I got to go to a new expiration because these expirations don't have a lot of time. And then I'm trying to go ahead and maybe make, you could say, hey, I'm trying to make back my 50. More aggressive traders will try to make back, let's say 100, because they'll try to make the 50 plus the 50 before. And even more aggressive traders might try to make the $200 here, somewhere in these ranges or something like that. Now you could go even further, like a 30-day and so forth, but it really just depends on your trading time horizon. Hope that helps. Truly appreciate you joining me. Hope you found that video helpful, and I hope it answers your question. Feel free to join us on our Facebook group, website, and coaching thing that we do, where we work with people together for multiple months to teach them how to trade properly. Anyways, thanks again. I'll see you next time. Take care. Bye-bye.